buy at Cantor Fitzgerald. The firm says the sell-off is a buying opportunity ahead of catalysts like the rollout of robo-taxis later this year in Texas. Tesla up 2.5%, getting a breather this morning. But next up, Oppenheimer is downgrading a number of financials today, including Goldman Sachs, which is no longer a buy at the firm. And the firm says there are no signs of an M&A rebound for the group, thanks to tariff threats and trade uncertainties. You do still have Goldman pretty much flat on the day, but down on the year. Finally, Restaurant Brands, the parent company of Burger King and Tim Hortons, getting upgraded to a buy at Argus Research thanks to its growth potential, Matt. People are still going out to eat, it looks like.
Yeah, well, at least for now. We'll see what happens when prices start to go up for everything else. UBS strategists expect the MSCI World Index to climb an estimated 9% in 2025, saying preconditions for a bear market are not in place, and the growth scare in the U.S. can be balanced out by growth elsewhere. And I think this is the key, right? They're talking about the global index, the MSCI all-country index, and we've been watching this rotation out of U.S. stocks and into European stocks, as well as you can see the MSCI China is absolutely on fire there. So a lot of reasons given by Andrew Garthwaite and his colleagues in this note, but they say, number one, AI should boost productivity. And I think that's interesting that they list that as their first reason globally.
Yeah, I also think that what's interesting as part of the trade is how much is poured into defense. You've been pointing this out since the very beginning, but if you looked at an S&P sector breakdown here of what's performing, Rheinmetall is performing well above everything else in that index, and now you start to talk about valuation once again.
All right, coming up in the next hour, Guggenheim's Jim Milstein joins us on the Fed, the economy, M&A, and much more. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Bassett. Katie Greifeld is off today, and coming up, it's decision day. The Fed is expected to enter wait-and-see mode, stuck between lingering inflationary pressures and mounting growth concerns. And before that decision, we're going to survey the investment climate with Jim Milstein. He's co-chair of Guggenheim Securities and a former Treasury Department official. Plus, Ukraine's Volodymyr Zelensky said he's going to have a phone call with President Trump today. We're going to hear from White House Special Envoy Steve Witkoff.
All right, let's get a check on what's going on in the markets. Just let's see, we are 4.5 hours away from the Fed's press conference. We'll get the decision, obviously, before that, and the dot plot, importantly, but we're not expecting much out of really either. S&P 500 right now up about 0.6%, so markets climbing to session highs a half hour into the trade. The NASDAQ 100 leading the way up 0.7% as tech stocks and Tesla are rising. Tesla leading the Mag 7 higher right now. And you see the 10-year yield still at 4.31. Really been stuck in this range now for the past couple of weeks, so holding at 4.30.
Yeah, it's pretty remarkable, especially when you think that there are two Fed rate cuts priced into the market right now. There's a disconnect. All eyes are on the Federal Reserve because investors are waiting clarity on the Fed's future moves. Take a listen.
It's really not where you want to be as a central bank. They're going to be revising down their growth forecasts. They're going to be revising up their inflation forecast.
The first thing would worry me if suddenly they do what they did on inflation in the past, which is start changing the definitions.
I think the Fed's just going to be looking at the numbers and seeing, are prices coming down or going up?
Stick with what you saw in the data coming in at the end of the year, and keeping this wait and see mode.
I suspect that they will be tempted to be data dependent, and if they're tempted again to be data dependent, the risk of a policy mistake is much higher.
I do think in terms of making any commitments about the path of policy is probably one they're going to be stepping back on at this point.
Joining us at the desk, Jim Milstein, Guggenheim Securities co-chairman, a legend on Wall Street and in Washington. Jim was the Treasury Department's chief restructuring officer under President Obama and a very good person to talk to when people are very worried about the economy, frankly. And so, one thing is that you see investors pricing in now 2 rate cuts this year. There were 3 priced in. So the outlook is still a little bit sour, but maybe not as dire as before. You see so much under the surface because you're also a restructuring advisor. Do you think that the fear is warranted?
Well, I think as the chair said at the last interview he did, he's looking to the Treasury Department and to the White House at this point to see the direction of their policy. Tariffs are a big change in the potential economy of the United States and the world economy. And so that will influence both short-term price pressures as well as economic activity. So I think he's kind of frozen for a while until he sees really where we're going with tariffs and how the rest of the world reacts to those tariffs. And whether we get a growth slowdown as a result of retaliatory tariffs, high tariffs being imposed here and retaliatory tariffs being imposed outside.
Can't we already tell? I mean, Jim Farley, the CEO of Ford, said these tariffs or the threats thereof are causing chaos and costs. And it seems to me that in the next round of CPI, PPI, and PCE, we're going to start seeing that shine through.
Yeah, I think just anecdotally, I think some of us are already seeing prices go up on the things we buy as a result of suppliers and sellers getting ahead of it. I think, in the short run, tariffs are an increase in the price level, but thereafter, it may just stay at that level. So the rate of change may not be great in 2026 as it will be in 2025 when the tariffs are imposed.
Well, but Jim, all this uncertainty in not only tariff policy, but we don't know what's going to happen with regulation. And tax cuts are in question, right? Mass deportations. That seems to be affecting everything from small businesses. When you look at the NFIB, no expansion, to Morgan Stanley and Citi saying like the M&A bankers and the IPO guys that we have not really necessary right now.
Yeah, I mean, listen, I think one of the two big pieces of legislation that President Trump got through in his first term was his USMCA, the tariff deal, the trade deal between Mexico and Canada.
It's the greatest trade deal anyone's ever seen.
According to the White House, yes. And as a result, I mean, that's been in place now for 7-8 years. And U.S. manufacturers, which is the sector that the Trump administration now wants to promote, U.S. manufacturers laid out their supply chains in Canada and Mexico based on the rules of the road established by the USMCA. So, that no one should be surprised that they were surprised by the threat of imposing 25% tariffs on Mexico and Canada, our two largest trading partners. And why are they our two largest trading partners? Because the USMCA created a roadmap for how to take advantage of relatively lower wages in Mexico and take advantage of relatively lower commodity prices in Canada to set up your supply chains for domestic manufacturing.
Aside from tariffs obviously creating a lot of havoc in the market, that's fair to say, on tax cuts, one question I have, this was supposed to be one of the biggest parts of the pro-growth agenda, that and lighter regulation. But how likely is it that we see a lot of those promises come to fruition? And if we don't, does it stifle that pro-growth story?
Well, let's first be clear and level set, right? So the extension of the 2017 Tax Cut and Jobs Act is basically the status quo ante. If it isn't extended, you would have a tax hike on households. The corporate tax cuts were made permanent, but the household cuts were not. So if they don't extend them, you're going to get a tax hike. But if they do extend them, it's just the same tax regime we're in today. Now, President Trump, as he campaigned, talked about further tax cuts, no tax on tips, no tax on Social Security, no tax on overtime. That would, the estimates are all over the place as to what that cost to revenue would be, but let's assume it's somewhere between $200 and $300 billion a year. So over the 10-year period, another $2 to $3 trillion worth of incremental debt for those tax cuts. At a time we're already running a deficit equal to 7% of GDP. So let me just stop there a little bit, because this is really, to me, I guess if you're a hammer, everything looks like a nail. If you're a debt restructuring guy, everything looks like a need for a debt restructuring. Today, our federal debt to GDP ratio is basically 1-to-1. We're running a 7% of GDP deficit this year, okay, which means the debt is increasing by 7% a year, whereas the economy has only been growing at 2 to 3% a year. So we're basically becoming more indebted over time because the growth of the economy is not outpacing the growth of the debt. So there's a massive need for what we call in the trade fiscal consolidation. We need to get our house in order and create revenues closer to spending.
Well, and they're hoping to get those revenues with tariffs, I guess. In terms of the cuts, I mean, Scott Bessent has this 3-3-3 plan, but it seems so unrealistic to get the deficit from 7% down to 3% if you're only able to find like $58.26 in waste and fraud, right? Because they're not attacking Medicare and Medicaid and military spending. They're trying to fire people at U.S. aid,
right. Which also, guys, especially as growth is expected to slow. I think that's a part no one's talking about here. That how do you grow into that if the GDP forecasts are being revised
the tax cuts
downward?
Right,
so let's be fair to Mr. Bessent.
Yeah.
He's talking about a 4-year trajectory to get the deficits down from 7% of GDP to 3% of GDP. He's talking about goosing the growth rate of the economy to 3%, not in the sort of low 2s, high 1s that we've been in. and trying to moderate inflation by having more energy production. You know, with oil in the 60s, you're not going to get more energy production here in the United States. It's just not, return on capital isn't there for that. So let's put aside whether or not that's the best way to deal with inflation. How do you goose the growth rate? Well, the theory of the administration is that deregulation is going to free animal spirits in the business community, that the tariff walls are going to create a surge in domestic investment to produce, because behind those tariff walls you can be more competitive against foreign competition. The problem with all of that is it takes a lot of time. Deregulation is going to take a lot of time. The rules that are currently on the books that they want to get rid of, the agencies actually just can't say done by executive order. They have to go through a rulemaking process. They have notice and hearing, and they have to unwind the regulatory state is going to take, even if they move with lightning speed, is going to take a year or two to fully unleash the animal spirits. And with regard to, setting up new production facilities in the United States and reorganizing our supply chains, that's a multi-year effort. So, and you're doing it against the backdrop of high tariffs, potentially retaliatory tariffs, which could be a growth slowdown, as you say, Sonali, which means that tax revenues might shrink in the short term, and God forbid we have a recession. And then not only do tax revenues shrink, but expenses go up because of all the counter-cyclical programs we have to ease the pain of a recession.
All right, we are fortunate enough to have you with us for another block.
Well, let's see about that.
So,
You stay right here.
You're going to stay right here, Jim, and we're going to talk more about this and about bankruptcies, because as you mentioned, you are a restructuring expert. I want to quickly get a look at some of the stocks that are moving right now as we hit really session highs on the indexes. The NASDAQ up. Looks like more than 1% at this point. You can see a Tesla rising 3%, NVIDIA rising 2 and change. Now, it doesn't make up for the drops that we saw yesterday, and not nearly for the drops that we've seen so far year to date, but it's doing quite well. In terms of reversals, Intel is another one because it had been gaining, and now you see Intel getting a 5% haircut on the day. So those are your big tech stocks that we continue to watch for you, and we'll get back with more with Jim Millstein after this break and ahead of the Fed. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Boeing shares are jumping in the early trade after the plane maker's CFO spoke at the Bank of America Global Industrials Conference in London. Although the company has some worries about the availability of some parts, investors were cheered when he said the firm's off to a good start this year on its success factors. Starboard is preparing for a proxy fight at Autodesk, according to a report from the Wall Street Journal. The activist investor has been urging a shakeup at the software maker for about a year, and last August, Starboard pressured the board at Autodesk to reevaluate the performance of the company's CEO after accounting issues at that company to make AutoCAD and other software. Purdue Pharma has filed a new Chapter 11 plan with the U.S. Bankruptcy Court for the Southern District of New York. The company is pledging to give creditors, including U.S. states and other parties, more than $7 billion in cash to compensate victims of the opioid crisis. According to a statement, a new public benefit company will be created after Purdue is devolved, and the Sackler family will lose ownership interest and have no role with the new firm. Sonali?
Speaking of bankruptcies, we have Jim Milstein of Guggenheim Securities still with us here on set. And I want to pull up BCY on the Bloomberg terminal because you can see just how much you're seeing bankruptcies, particularly loaded to the consumer discretionary sector. And something about this that is a bit deceiving, Jim, is something we were talking about in the commercial break here. Actually, you're not even seeing the bulk of the pain in the Chapter 11 filings. You're seeing it in the way that creditors are working out the way they're trying to keep companies alive through additional debt that is coming at high interest rates, frankly. Even if you see the Fed cut twice this year, does that relieve these companies of the pain they're struggling through of refinancing at these higher rates?
No. The answer is no. So, you know, you look at the credit markets and the corporate credit markets, there was a huge surge of refinancing activity that went on when rates were low in the early post-COVID period, when the Fed had driven rates back again down to virtually zero before the bout of inflation. Most corporate debt has a maturity of 5 to 7 years, so we're now at the end of the maturity of that wall of refinancing that went on there. So now we've got a new wall of refinancing that's required at much higher interest rates. So even if the Fed knocks 50 basis points off the low end of the curve, the short end of the curve, the far end, that, you know, the belly of the curve out in the 5 to 7 years zip code, companies that did their financing back in 2020, 2021 are now going to be refinancing in a much higher interest rate environment. And, you know, as the uncertainty, the general macro uncertainty creeps into the credit markets, you're seeing a slow, not dramatic, but a slow uptick in spreads in the non-investment grade market. And so both higher base rate and higher spreads are going to create higher interest burdens.
Why are spreads so tight right now? I mean, especially if you see an increase in bankruptcy or a concerning absolute number of bankruptcies, why do you have spreads, even junk spreads, so tight? There's
just a tsunami of credit availability right now. There has been, you know, the growth of the private credit businesses, which is unrelenting and continuous, you know, which in some ways really recycling money out of the insurance industry, which used to be big bond investors and continue to be bond investors, into a series of specialist funds to do their underwriting. And, you know, there's plenty of bank liquidity available.
And private credit.
Yeah.
No, as I say, private credit.
Yeah.
Well, to that end, is this masking some of the pain that's really under the surface? What are you seeing? Because when you think about it, banks say, well, consumers are fine. But Bank of America, an average FICO score is well over 750. It's almost 800 for many of its credit lines. And so you're not really seeing the American consumer there. You're not seeing the painful companies that are maybe being turned away from a JP Morgan type firm today.
Yeah, so you take the, 4 years of pretty high inflation. And while there has been wage growth to compensate, that wage growth is moderating. So you're really seeing the consumer starting to be pinched. And that's why you're seeing the first set of distress show up in consumer-oriented companies. Again, this is with plentiful credit availability, and a change in the capital structures, particularly in the middle market arena, where you have not so much bank finance, but private credit. And private credit is usually one or two lenders. So when a company gets into trouble, even a private equity sponsored company, you can have a conversation like this about what are we going to do.
And nobody else knows about it.
What are we going to do about it? And so there's an awful lot of what we call liability management exercises going on in private conversations between a private credit fund and a private equity fund, or a private credit fund and a family-owned business.
So I've been bringing up these stats a lot lately that bank balances have declined over the past 12 months back to pre-pandemic levels, this across all income groups. Wage growth has slowed over the past 12 months across all income groups, and that Americans' inflation-adjusted debt is rising past 2019 levels across all income groups. And yet everyone says never count the American consumer out. And I've been doing this for 25 years. It's a good thing to say, right? Why is the American consumer so resilient, and does that continue?
It's about credit availability, and just look at the federal government, right? As long as people are prepared to fund, a $1.7 trillion deficit, we the Congress can continue to spend with abandon. As I said earlier, I think we're coming to the end of that cycle because we're at the point where the debt's growing faster than the economy. But as long as there's the last lender there willing to, lend you that dime to finance your spending, you're going to take it when the alternative is, a restructuring.
Yeah, or no iPhone, right?
Yeah, they're giving them away. You just have to sign a contract.
Yeah.
Obviously, a lot of things to watch around the corner. Jim, we thank you so much for your time. Of course, that is Jim Millstein of Guggenheim Securities, watching for everything that's weakening under the surface and how significant it may be. But still ahead, Gilead Sciences is getting hit after a report that the Health and Human Services Department is thinking about reducing federal funding for domestic HIV prevention. Just another place you're seeing funding pulled back. We're going to give you details next on Bloomberg Open Interest. And it's time now for social climbers. The company's making waves this morning. First up, Gilead is falling after a report that the U.S. Department of Health and Human Services is planning to cut federal funding for HIV prevention programs. Wall Street weighing in, saying that the reported funding cuts only represent a modest impact to this drug maker. Next, Roku jumping today after Trump Media and Technology launched its Truth Plus streaming app on its channel. Roku up more than 8.3%. Finally, the RV maker Thor Industries getting a downgrade at Citigroup. The firm cites reduced confidence in its recovery because of consumer headwinds. Super interesting, Matt, to see what's happening in those consumer stories today.
Yeah, especially in the RV space. I want to get one of those. But obviously I can't with the uncertainty in this economy. Let's get a check on the markets right now. We do see gains across the board in terms of the equity indexes. So you can see the S&P 500 right now up 0.7%. The NASDAQ right now up a little bit more, 0.9% as tech stocks and the Mag 7 kind of lead the way into this Fed meeting. Of course, we're watching very closely to see what Jay Powell has to say, as well as getting the new dot plot and the SEP. Coming up, uncertainty is starting to rise among business owners. We've been seeing that over the past couple weeks. We've got a read on how owners are feeling with Andmore CEO John Pertchek. He joins us next to talk about his B2B business. This is Bloomberg. The latest NFIB survey shows uncertainty is growing among small business owners. The amount of owners who said now is a good time to expand fell to the lowest level since April of 2020, just after COVID hit. For more on how businesses have to plan ahead or dealing with these headwinds, we're joined by And.More CEO Jon Pertchik. And.More offers physical B2B marketplaces that end up being the biggest trade shows in the United States. We're talking massive trade shows, John, right? Like 21 million square feet of space for business owners who need to make forward planning. How are they dealing with the current economic environment?
Thanks, Matt. Thanks for having me. Yeah, we're the largest marketplace that brings buyers and sellers, buyers being retailers, sellers meaning manufacturers of furniture, gift, and apparel. We've got 21 million square feet in Las Vegas, High Point, North Carolina, and Atlanta. And we do reflect the sentiment of consumers through those anticipated buying behaviors of those retailers from our manufacturers. January, your last segment talked about the resilience of the American consumer. January, which was our most recent major markets, the buying power, the amount of activity was actually extraordinary, which gives at least a glimpse into how people were feeling as of January. Now that may have changed, it may be evolving, I don't know. But as of the latest indicator we have, sentiment was pretty positive.
You know, one of the things that you have at these trade shows is furniture. I think that's a really interesting place to look right now. I grew up myself in Paramus, New Jersey, and the highways are lined with furniture stores and car stores. And when things get rough, some of these stores tend to go away. It's really brutal, but it's an economic indicator in a lot of ways. People are having a hard time with homes, John. People are having a hard time buying things to fill those homes. What does that part of the market look like for now when you talk to business owners?
Again, I'll tell you from the activity we've seen just in the last couple of months, again, January, our next major market is in April. And so far the activity leading up to that, the bookings and what we expect attendance will be are pretty positive. So what we saw in January tells a bit of a different story. There was a level of optimism. Again, the buying power, the amount of activity we saw at that market, those markets, I should say, plural, multiple markets in January, winter being one of our biggest, that and July are our two biggest moments, was quite positive, which would suggest a different perspective of the American consumer than what we're sort of seeing most recently in some of the news related to tariffs and otherwise. So I still have a pretty positive outlook, and the conversations I'm having, more just anecdotally with some of our customers, have also remained fairly positive.
You know, we were looking at an inflation map a couple of days ago, and you can really see it on the coasts, but it's not as bad in the middle of the country. And likewise, with the tax changes that we've seen really in Trump 1.0, the coasts were hit much harder than the middle of the country. Do you see a regional breakdown in terms of the businesses coming to your marketplace?
That's a great question. It's a little early for me to say and to get that specific geographically. What we saw in Atlanta and Las Vegas again, January being our most recent major activity, levels were very positive in both places. And Vegas would tend to draw from sort of the West Coast and to some extent inland, meaning like Scottsdale, Phoenix. And Atlanta more the East Coast, but spread. It will draw from the Midwest and other places too. So it's a little hard for me to discern and give you anything really firm on that basic point.
John, if you're feeling really positive about things now, despite kind of what some of the more underlying concerns show in economic data right now, then do you feel the opportunity to expand more? The idea of being greedy when others are fearful?
I'm all contrarian in terms of it. I've made a career partly out of expanding when others are contracting, and just in general. So I'm a fan of that often. We are focused on expanding, and we don't own any real estate. As I said, we own 21 million square feet. We have a show where we don't own real estate in New York, and I expect we're going to be starting expanding there. We're very focused on that, and I think we have some other expansion opportunities. So partly based on my relatively more optimistic view than others. I think we do have opportunities to expand. Separately, we're in the middle of or I should say the beginning, first or second inning of a major transformation in Anmore. I have a whole new senior team I brought on. I'm big on codifying my plans. I have a transformation playbook, leveraging a little bit of AI, leveraging something called WOW, which is an acronym for ways of working, doing things differently. So I'm really optimistic that we're in a unique spot, partly because of the changes that are underway within the company, and partly because of some of the growth opportunities we have.
How does the income statement look, if you don't mind me asking? What about your financing needs? Is there any possibility of an IPO in your future?
You know, who knows? I mean, I'm here to create long-term value. And by the way, I would say with all this uncertainty that's been out there, lately, I'm very happy I'm not running a public company right now. My last company was a Fortune 500 public company. I'm very happy to be running a private company. So I won't reveal the details, and I know you're not asking for them. But creating long-term sustainable value, which is what I'm really focused on, could lead to all sorts of optionality. Whether it's an IPO, that could be in our future, who knows, or something else. But it's a really exciting time at this particular company.
John, great to get some time with you. Thanks so much for joining us. John Perchik there of Anmore. They put on the largest trade shows we can say in the U.S. and possibly the world. John, great to spend some time with you. Thanks so much. Let's get a check on what's going on in these markets as we head toward the Fed. Right now, S&P 500 index up about 2/3%. And we do see the tech stocks kind of leading the way here, with the NASDAQ 100 up about 0.75%. In terms of the stocks that are on the upside right now, Apple adding the most points, NVIDIA a big gainer, Microsoft, Tesla, Netflix, all doing well. And you can see the 10-year yield not doing a lot at all. In fact, we really haven't seen any volatility in treasuries lately, which I think is pretty fascinating.
Yeah, it is. It's been very volatile. 430 is the new normal. And also, just really quick comment about the market here. A lot of people have been watching that first half hour of the trade to see if it sticks, basically. And today we're not only sticking, we are higher. Let's see if it lasts through the day. Of course, there's been a lot of intraday headlines, but a little bit of calm feels good after as much selling as we've seen. Some stocks moving under the hood this hour. General Mills has been cutting its forecast, citing retailer inventory and a snacking slowdown. This is not the only place we're seeing that, Matt.
I wish that was the case at my house.
I mean, I just finished a pint of ice cream myself last night, so I'm with you. But also interesting here, Signet Jewelers just soaring today. Whoa. Wow. The owner of Kay Jewelers, these are diamonds, of course.
And gold.
And gold, says sales are recovering after a disappointing holiday season. I wonder if people are out there falling in love and stuff like that.
Probably not. It's interesting, I think, that gold is trading over $3,000 and holding, right? It's been a few days now, and it's right now trading for $3,030. Williams-Sonoma is one we were talking about this morning, because the company, which owns also Pottery Barn as well as West Elm, but we know them for their kitchen products mostly, it reported fourth quarter profit that was far better than the street was looking for, and raised its dividend, I think 16%, which was more than Bloomberg had forecast as well. And nonetheless, the shares are down 12%. Concern really about the consumer as they put out a forecast that really didn't excite the street.
One thing that's kind of disappointing about that too is that dividend story is a huge part of this market right now. Investors want to see it, but in this case, even a higher dividend is not helping the stock shake off consumer fears. Now, coming up, we're going to talk about what's happening in geopolitics, because President Putin is operating in good faith, according to White House Special Envoy Steve Witkoff. We're going to bring you more from our interview and the latest on Ukraine next. This is Bloomberg Open Interest.
Let's get to Washington now. President Putin rejected President Trump's call for a 30-day ceasefire in Ukraine after the two leaders spoke yesterday. President Trump called the talks Moscow only agreed to limit attacks on energy infrastructure while demanding a stop to the flow of weapons and intelligence to Ukraine. White House Special Envoy Steve Witkoff spoke to Bloomberg and gave us some more detail. Let's listen in.
What was agreed between the two presidents was, and it was at President Trump's suggestion, that there be a cessation of attacks on energy infrastructure from both sides and civilian infrastructure for that matter. Also, working towards a Black Sea moratorium on hits on naval vessels and freighters carrying grain and things of that sort, and ultimately that would evolve into a full-on ceasefire, which is a bit more complicated because there's a 2,000-kilometer border, there's Kursk, and there's a lot of details that go into that. But with regard to your question on some of the reporting with regard to the Russian drones last night, I have it on good information from a telephone call I had before I went on this show that President Putin issued an order within 10 minutes of his call with the president directing Russian forces not to be attacking any Ukrainian energy infrastructure. And any attacks that happened last night would have happened before that order was given. In fact, the Russians tell me this morning that 7 of their drones were on their way when President Putin issued his order, and they were shot down by Russian forces. So I tend to believe that President Putin is operating in good faith. He said that he was going to be operating in good faith to the president yesterday, and I take him at his word.
So, Mr. Witkoff, is your understanding that as of today, energy facilities, energy infrastructure will be off limits?
That's my understanding, yes, ma'am.
Do you think the next stage potentially, as we get the roadmap towards a 30-day full ceasefire, potentially geography should be off limits, like drones hitting Kyiv?
You know, I can't speak to that. I think the idea behind a 30-day ceasefire, first of all, we made more progress yesterday than has been made in the last 3.5 years. The two leaders actually talked and committed to cessation of attacks on energy infrastructure and civilian infrastructure. They talked about reviving the Black Sea maritime agreement that had been negotiated several years ago and never really implemented. Those are monumental things, and they're trust-building things as well. And I think beyond that, they also went into how you would put the finishing touches on a full-on ceasefire. That full-on ceasefire has a lot to do with this 2,000-kilometer line that where the Ukrainians are lined up against the Russians. It's complicated. There are different battlefield conditions in various spots. That's for the technical teams to figure it out. And they're going to be meeting in Saudi Arabia, I believe, beginning Monday and Tuesday. So lots of progress happened yesterday, and it happened in large part because of President Trump.
Let's stay on this story because, of course, it is a live one. Joining us now, Bloomberg's Tyler Kendall in Washington. And, of course, to recap a little bit here, you have Steve Witkoff denying that Russia broke an agreement to not attack Ukrainian energy infrastructure, and Anne-Marie asking him whether certain places should just be absolutely off limits here. He said that progress made in the last 24 hours was better than progress seen in the last few years. But the definition of progress here, how much is that up for debate right now as they look to a lot more lasting peace and certainly a more significant ceasefire?
Well, Shonali, you're exactly right. There's now these firmer questions about exactly how firm, really the only tangible deliverable that we got yesterday when it came to a supposed halt on attacking energy infrastructure in Ukraine. We're expecting to potentially get some more details even later this hour. According to the White House, we are expecting that call against Ukrainian President Zelensky and President Trump is expected to have already started. In the wake of this, Zelensky says that he will be urging U.S. and its allies to try to ramp up, exert more pressure on Russia in order to get them to the negotiating table in what Zelensky has called good faith. He's floated, for example, trying to tighten sanctions additionally. That's something that this White House really hasn't ruled out at this point, but it does remain to be seen if that is something that the U.S. would do, considering that the White House so far, Steve Witkoff there, President Trump, have really tried to frame this call as a positive step. We heard from the Kremlin this morning, for example, saying that the U.S. committed on that call to a, quote, gradual normalization of relations between Moscow and Washington, something that we know the Kremlin was keen to look into. But importantly, we have to keep this all into context. Yesterday's call really did fall way short of expectations from the U.S. when it came to their main deliverable that they were going after, which was to get Russia to agree to that 30-day ceasefire plan. Up next, we are looking ahead to those anticipated talks next week in Saudi Arabia. We are expecting the maritime potential ceasefire to be the next thing on the table as we look ahead to that.
Surely Zelensky, Tyler, wants Russia out of all of the territory it's taken, maybe with the exception of Crimea, since that's been annexed since 2014. Do you have any indication of whether or not the White House is insisting that the Russians vacate the Ukrainian land they've moved into, or whether or not President Trump is willing to give that to Vladimir Putin?
Well, that is one of the biggest questions, particularly after President Trump said that they were already talking about dividing up the assets, as he called it, alluding to territory concessions and also critical infrastructure there. Now, according to a tracker that we trust from the Council on Foreign Relations, about 20% of the country right now is currently under Russian occupation. Zelensky said earlier this morning that he has no intentions of recognizing any Russia-occupied land as Russia's occupied land moving forward, that for him is going to be a red line there. We're going to have to wait and see particularly how that point moves forward here as we learn more about, for example, one of the things on the table, whether or not a huge nuclear power plant could be up for discussion as they continue these talks.
Tyler, we thank you so much for all of your reporting and, of course, for keeping an eye on the situation over the last 24 hours and over the next 24. That is Bloomberg's Tyler Kendall. Now, coming up, the Fed decision just hours away. We're going to tell you what you need to look for, what you're going to expect next. This is Open Interest.
Let's get a check on the markets. Almost an hour and a half into the trading session, we still see green arrows across the board. Not the session highs, but better than the lows on the S&P right now at more than 0.5%. The Nasdaq gaining 0.2% as tech stocks together with Boeing really lead the way here. I think Eli Lilly, Boeing, and then the Mag 7 are all adding points to the S&P 500. You can see the 10-year yield there, very little changed, and that's no surprise as oftentimes markets are light on volume and making big moves before a Fed decision. Of course, the latest Fed decision is due today at 2 p.m. Eastern, and we're going to get a press conference half hour after that. Investors see almost no chance of a cut today, but they will be focused on any revisions to the Fed's forecast. Remember, we get the SEP today as well as the dot plot. Joining us now is Bloomberg Chief Economics and Policy Correspondent Michael McKee out of Washington. So, Mike, what are you going to be focused on? What are you watching for?
Well, we'll watch for anything that Jay Powell says in his news conference that might be taken as something of a Fed put. Wall Street is anxious to have the Fed backstop them, but I don't think Jay Powell is going to say much of anything at all. They don't want to do anything that would bring attention to them or mess up monetary policy right now. So no change in rates, of course. And then the dot plot everybody's looking at, they may go to one cut, but probably makes sense for them just to leave it at 2. As you mentioned, not much in the SEP either. The only thing that they might do today, but that wouldn't be very controversial, is to pause or halt QT while the debt ceiling is being negotiated in Washington. A lot of people on Wall Street think that might wait for the next meeting.
To your point about maybe going to one cut, what would that signify? The reason I ask is because the market is still pricing in at least 2 cuts through the end of this year. Is that really just signaling that inflation is going to stay too high for them to have meaningful change, even if the economy slows?
Well, that would be the takeaway, and that's why they may not do it. There's 2 possibilities. One is that they think inflation on its own is stickier than they thought and won't be coming down as fast, or they think the tariffs will raise inflation, and they probably don't want to get into that debate. So I would assume that their default is going to be, at this point, stick with 2, stick with basically the same economic forecast, because they don't have anything that tells them they're going to be much different.
Hey, Mike, in terms of the dot plot, how important is that to you? They seem to always say, you know, here it is, but don't pay too much attention to it. And it seems to me that it's quite valuable in forecasting what the Fed plans to do.
Well, Matt, you just put your finger on the problem there. The Fed would argue with you that it is not a forecast. It's 19 separate estimates of where the federal funds rate will be under the conditions that each member of the Open Market Committee thinks will obtain at that time frame. So if you think inflation is going to be X and unemployment is going to be Y and growth is going to be Z, then what would be the proper Fed funds rate at those criteria? And so they don't like the idea that it's a forecast. It's a much unloved item in the Fed's arsenal, but they don't see any way to get rid of it at the moment. So they just have to keep reminding people not to take it literally.
So hang on, Mike. It's each member's forecast put together, and we're encouraged not to think of it as a forecast.
Right, essentially, although they would say it's not even a forecast from each member. It's just kind of a guess at where things would be under their forecasts for the economy. But what happens is we take the median, but there's a wide range of views on what it could be. So the cone of uncertainty is really wide. And so they think that Wall Street makes a mistake by taking this as a promise or a strategy. It's really just here's the possibilities ahead.
Mike, we thank you so much for your analysis. We're looking forward to your coverage this afternoon. That is Bloomberg's Michael McKee in Washington. Stick with Bloomberg for special coverage of the Fed decision and news conference. A host of guests, including Diane Swak of KPMG and former New York Fed President Bill Dudley. And of course, we're looking at a market that's up, including much of the Magnificent Seven. And a good day in the markets. We'll see if the Fed starts to change a little bit of that course.
Absolutely. Tech stocks really gaining for the most part today, with the exception of Intel. This is Open Interest.
from the heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Tim Stenovec in San Francisco. This is Bloomberg Technology.
Coming up, NVIDIA CEO Jensen Huang unveils new AI chips and technology at the company's annual developer conference, but fails to wow investors. We'll have all the details. Plus, China's Tencent posts its fastest revenue growth since 2023, with the company planning to ramp up AI spending. And Cloudflare out with new cybersecurity products aimed to help safeguard against AI vulnerabilities. We speak with the CEO, Matthew Prince. But first, we check in on these markets, which are not all consumed with AI, but instead all consumed with the Fed. We're currently up 0.5% on the NASDAQ 100, bouncing back off what had been a significant sell-off yesterday. And overall, we still contend with the macro forces versus the micro. On the points higher, though, Apple doing well to push the NASDAQ 100 higher. So too is NVIDIA, and we go into that particular name as GTC continues. We're up 0.9%, but remember it fell 3.4% yesterday as Jensen Huang took to the stage, unveiling a whole host of new AI improvements, chips that move from the Blackwell Ultra onto Vera Rubin. We also get a new scientist name for the next iteration. But Tim, it didn't wow investors, it feels.
It didn't. There's always today, and there's always the rest of the week. For more on NVIDIA, Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, there's this narrative emerging that AI costs are just getting out of control. What did we see yesterday? What did you see yesterday from NVIDIA that said to customers, you're getting more value out of what we're bringing you?
Well, one, there was a clear shift towards reasoning, and the fact that he said reasoning requires 100 times more compute. So from that perspective, the demand trends seem to be reassuring coming from NVIDIA, and clearly they are ahead when it comes to the performance per watt that everyone seems to be focused on with these chips. And look, you could argue, there isn't a new end market on the horizon, even though they announced, the partnership with GM, or the humanoids was part of the keynote as well. But to me, it's still all about data centers and servers. And they seem to have a very clear roadmap till 2027 in terms of what kind of performance improvements they're looking with the next version of their chips.
I think Vera Rubin expected to 3x the improvements on Blackwell Ultra. We get Feynman being the next name for the future platform of focus. But look, analysts are overall once again declaring that the moat is strong. They're maybe 8 years ahead of the competition if you're talking to certain hyperscalers. What more can he do to juice what's currently in the valuation right now?
Well, so if you look at the trajectory of NVIDIA's numbers, they have always moved to the upside because they have come up with something new, or an additional customer that is of the same ramp up as a
Photons not new enough for them?
Well, so you have to look at the hyperscale investment, and they are all developing their own ASICs. So the fact that you have competition on the horizon, even though NVIDIA is way ahead of everyone else in terms of performance, but you just can't rule out the fact that ASICs are a real possibility. That's what Broadcom called out. And to me, that competitive environment will get challenging. And look, they made the pivot to reasoning after DeepSeek. This wasn't 6 months back. It was all about pre-training. The keynote this time around was all about inferencing and reasoning. So they're very good at making those pivots. But the fact is the market keeps evolving. And I think ASICs are still a real threat when it comes to NVIDIA sales at the data center level. Yes, it's a $1 trillion market, but who can give the assurance that it will be NVIDIA who captures most of that end market? Because your competition is the 4 or 5 main hyperscalers that are still looking to develop that ASIC option.
Frenemies continue. Mandeep Singh of Bloomberg Intelligence, love having him. Meanwhile, a wider investor look now at NVIDIA and some of the others in the chip sector. Kim Forrest, Boca Capital Partners CIO, joins us. And Kim, we mentioned how their own clients are becoming their competitors, not to mention AMD still trying to be an also-ran in this space, not to mention Intel really languishing. But can NVIDIA remain the king when it comes to AI?
Well, maybe. I think it's a strong maybe there. And maybe they do rule the hardware world, or a lot of it, because, you know, there really is no substitute right now. Here's the thing, though. Human beings are incredibly inventive. And NVIDIA, although they always trot out the fact that they have software that developers may use, I think the very largest developers that are using these chips are writing their own software, not depending on CUDA. So keep that in the back of your mind. But I believe what DeepSeek has shown the investing world is there's more than one way to skin a cat, and just throwing really expensive chips and tons of chips at a problem is not always the answer. So I'm looking out there for innovation in the software world to make the build out of a data center a little less like key into developing AI in the future. So more software, less hardware.
Kim, do you think that the market has fully priced in the impact of DeepSeek?
No, actually. And I think this is a really difficult area to talk about AI without really nerding out. So let's keep it at the 50,000-foot level.
This is the show to nerd out on, Kim. This is a show to nerd out on, just saying.
Okay, yeah, but okay, I'm trying to restrain myself. But here's what I see is the essential problem, is there are limitations in the physical world, power, you know, how quickly you can build a data center, how quickly you can build chips, the machines that create these exotic chips, how quickly you can build that. It's all a physical world problem. In many ways, software is exactly what we've used in the past to become more productive. And why not use it on AI itself to use these data centers that we already have and rethink the software and the training, testing, and validation kind of exercises we do to build large language models? Why not make that better by better software? Crazy.
Well, you have the background to nerd out on this, because before finance, you spent more than a decade working on this stuff. I mean, this was 20 years ago. So you've been thinking about this stuff for a long time. But now, do the economics of inference work? Do the economics of agentic models work right now?
I don't think so, because they're so expensive to build, and it doesn't look like people are lining up to buy it. I mean, is it really that simple? I think the answer is yes. I have not been convinced that there is a strong enough problem that can be easily identified and thus monetized in AI. Do I think it's the future? Absolutely. But I think that businesses who have to put their assets at risk buying this stuff and then using it, and remember, a lot of large language models are 85 to 95% correct, and that is underwhelming, you know, if you're going to build your business on something that's incorrect, you know, 10 to 15% of the time.
Yeah.
These are real world problems that we have to get unexcited about and fix. And again, my answer is software, because that's what that's my book. I know that area, as opposed to building better hardware.
Well, go to the software. Go to the newly released open source software, Dynamo. And look, there's crowing that makes DeepSeek's R1 30x faster when you run this new open source software being offered by NVIDIA. So are they not adapting quickly enough? Because it certainly feels as though they've got an answer for everything.
Well, I think what we really have to do is attack, I mean, faster is better, right? But then how do we stop wrong answers? That's where the humans have to come in and kind of build stuff around that to wall off the bad answers. And you know, whenever I was doing this back in the late 90s, that's where a lot of our time was spent on refining the models, was to make sure that we weren't returning bad answers. And I don't really see that as a focus. And again, I'm talking my book, what I know, and it's still a problem. That's the crazy thing. You know, 30 years later, wrong answers are still a problem.
Kim Forrest of Boca Capital Partners. Kim, always great to check in with you. Appreciate you joining us today. Meanwhile, as many as 400,000 NVIDIA chips are set to have a new home in the small city of Abilene, Texas. It's the site of the first data center complex for OpenAI's Stargate infrastructure venture. According to the developer, the project will be completed by mid-2026 with support for hundreds of thousands of AI chips, though no word yet on how many chips have been committed to the project so far. Caroline?
Coming up, we're talking connectivity and connectivity firm Cloudflare introducing new AI tools to take on vulnerabilities. We're going to be speaking with the CEO, Matthew Prince. That's next. This is Bloomberg Technology.
Cloud connectivity firm Cloudflare is in the midst of its annual Security Week, announcing a slew of new products, including one to help safeguard against AI vulnerabilities. Here to discuss is Cloudflare CEO Matthew Prince. Matthew, you just announced Cloudflare for AI this week. It essentially allows customers to safely use and develop AI tech. Up to now, though, what has been the problem? What has been the challenge? What has been the vulnerability?
You know, I think the thing that's really hard in the AI space is, as your last segment was talking about, is everyone's just rushing as fast as possible. Everyone's board is saying, what are we doing in AI? And everyone's trying to go as fast as possible. And what that means is mistakes get made. Data that shouldn't leave your enterprise gets sucked up into an AI model. People maybe are using AI in a way which might embarrass you or your firm. And what we've heard from our customers is that they want guardrails. They want controls to be able to make sure that even as they go as fast as possible, they're not going to break anything, which is really, really important. And so that's what we're launching with Cloudflare for AI. And we're really excited to see already customers using it to make sure they can go as fast as possible, but not make those critical mistakes in the space of AI.
Matthew, you've got so many current security offerings already when you think about web applications, firewall, observability, API protection. What's new here in terms of Cloudflare for AI? Is it a new bundling thematic, or is there really new offerings coming?
I think that it is a combination of building on the foundation that we have, where we can process just vast amounts of data flowing through our systems, do analysis, do all those controls, but then adding on top of it, not just how are we looking for hackers, how are we looking for threats, but how are we actually looking for the ways that people might be using AI in a way that might be embarrassing to a company, in a way that might be revealing secrets that are there. And I think part of what's powerful here is, yes, we have a whole bunch of customers that care about keeping their use of AI secure, but a lot of the AI companies, in fact, most of the major AI companies also use Cloudflare. So we've been able to actually integrate those two sides in a way that give you a holistic offering and make sure that you can, again, go as fast as possible with AI, but do it in a way which is secure and has real guardrails.
That speed, that desire to get out in front when it comes to AI, many would class that as hype. Can you just set the broader context here of whether you think the AI hype is turning into AI productivity reality?
Yeah, I think there's anytime you have something which is as disruptive a new technology as AI, there are going to be a certain amount of money which is spent on it, which is just lit on fire. And I think that's just the reality that's there. But what we're seeing is that there's real value which is being created as well. And so even if we assume that only 1% of what's being done today turns into value, what we see from our customers, what we see from the AI companies that are out there, is that 1% has the opportunity to have enormous returns. And so, again, I think anyone who's not doing at least something experimenting in AI is probably missing the boat here. And again, I don't hear a lot of customers that are saying, gosh, we're going to shut down our AI efforts. Instead, I think people are stepping on the accelerator, finding more ways to use this. And again, I think we have to acknowledge some of this is going to be just lighting money on fire, but a lot of it is going to turn into real innovation over the long term.
Matthew, investors watching right now probably are wondering, how big of a business does this turn into for Cloudflare? What are you modeling internally?
So we don't forecast anything in particular, but what I will say is customers are coming to us, and this was a real demand that was driven by our customers saying, you are extremely well positioned to be able to solve this problem. This is something that we want and that we want you to build. And so I think that gives us a lot of confidence that as we invest in this space, that it's something where there will be real returns. It's something that customers want. It's something that the largest enterprises are realizing that they need, that they can't just go at the full throttle without those guardrails in place. And because of the unique position that Cloudflare is in, we can deliver those guardrails and make sure that you can use AI safely.
Because you're offering the platform to build, to deploy the apps, you're also offering the security. But paint the picture of the ecosystem right now, because people might be thinking, okay, your competitors are like AWS and Fastly, but then there's this deal with Google buying Wiz and what that does for overall security of infrastructure, cloud infrastructure. Where do you fit in with Cloudflare, Matthew?
I mean, those are all very different companies. And I think the first thing to say is congratulations to the Wiz team. It's incredibly hard to build companies, and the fact that they so quickly built something that had enormous value and were able to sell it to Google, I think is something that, again, deserves an incredible amount of, tip of the hat to them and what they're doing. I think the fact that Google had to build Wiz just shows how security has to be part of any cloud platform. And Cloudflare really started with security, and I think that's given us a huge advantage over time. Wiz is really great at identifying what an enterprise's security vulnerabilities are. And what we're proud of at Cloudflare is that we have actually been the solution, once Wiz had identified the problem, to actually solving the security problem behind the scenes, where they're recommending us as that solution. Google's been a long-term partner of Cloudflare. We hope that will continue. I expect that will continue over time. And I think integrating Wiz actually makes it make more sense for them to be integrating closely with Cloudflare and being able to deliver our services as one seamless offering.
Some of the best bird's eye perspective of the internet writ large. We love having you on. Matthew Prince, Cloudflare CEO. Thanks so much. Tim, what have we got?
Well, it's time now for Talking Tech. First up, Google launched a redesigned version of its budget Pixel phone, upgrading the chip and battery life weeks after Apple's lower-end iPhone 16 went on sale. The new Pixel 9a costs $499, in line with the price of last year's Pixel 8a. Plus, Tesla was granted approval to begin carrying passengers in California. The approval does not allow Tesla to offer rides in autonomous vehicles, but a ride-hailing business with human drivers could pave the way for Tesla to eventually introduce robotaxi service in the state, where Waymo already operates here in San Francisco. And Xiaomi is working to expand its production capabilities to meet demand. This comes after it raised its 2025 delivery target for EVs to 350,000 units, reflecting inroads into the Chinese EV market. Xiaomi Group Vice President and CFO Alan Lam joined Bloomberg Television in an exclusive interview to weigh in on this.
You see a couple of our EVs, right? The red one being the SU7, and then the yellow one, which is something that we just launched, is our SU7 Ultra, which we are selling at a starting price of over 500,000 RMB. We are running one factory right now in Beijing, which is fully ramped up. We are working very hard to squeeze the extra production volume out of that factory. But at the same time, obviously, we need to continue to expand our production capabilities by adding new production sites.
Coming up, Tencent quickens its AI spending after a boom in sales. Details up next for the Chinese giant. This is Bloomberg Technology.